a review of what we did last time, right? So, by the way, my name is Coach Rene. Bernard is my first name, but I go by Rene most of the time. Um, I'm a computer guy by trade. Did a lot of computer work for many companies. I learned options trading while working for Nasdaq. That was more than 26 years ago. But really, my passion really, even though by day I'm a software architect. I work for Amtrak. But really, my passion is in investments, trading, life insurance, and that sort of thing. So feel free to go on LinkedIn and then send me a request there to link up with me from around. So uh, last time I talked about my toolbox here. So this is just what I use. People have preferences. They have other platforms. I'm sure many platforms have the same features, but I happen to be using Tastyworks and Thinkorswim, just as an aside. And my charting platform is TradingView or Thinkorswim as well. I use FinViz for my screening most of the time. If I'm doing some research, I go on finviz.com. Okay. So we thought it was worth reviewing again, the key elements that really make up options pricing. These options are by definition decaying assets. When you buy an option, you start losing value right away. So there are three big things that I look for when I'm trading options. The first one is the option delta. In simple terms, the delta tells you basically, because in theory, they will tell you that an option controls 100 shares of the underlying being here a stock, whatever it might be. But that is not quite true. Only the delta tell you the true number of shares you're controlling. For a delta or something like of 0.5, that means you're controlling 50 shares of the underlying. A delta of 1 is a true option because it controls 100 shares of the underlying, right? So delta tells you, if I go here to my Thinkorswim platform here, for instance, and let's say I want to go here, let's say to American Airlines here, and I want to go here look at this option of January 21, and if I look at this option here, for instance, this option has a delta of 0.66. Okay, that means that this option here, this contract, only controls 66 shares of American Airlines. Okay, not 100. So that is a misunderstanding, a misconception. But if I go here to this contract here, where delta is 1, these first 3 contracts here I truly control 100 shares of the underlying. Okay, so that's what the delta tells you. That is one way of looking at delta if you are a market maker. Another way of looking at delta, it tells you by how much your option appreciates for every dollar the underlying moves. For instance, here, for this option here, for instance, at the 16th strike here, if the option if AAL goes up by $1, my option will go up by 66 cents. Okay, so that's another view of what the delta means. So when you're buying an option, look at those things, know what you're buying, know what you're controlling. All right. So that's basically what the delta is at a high level. The second thing you should be looking at is theta. Okay. Theta tells, because when you buy an option, like I said earlier, options are decaying assets. When you buy an option, it starts losing value. And how does that happen? Well, theta is your time. Okay, when you buy an option, you're buying time as well. Well, that time starts decreasing every single day the option the contract goes towards expiration. And that tells you exactly by how much. So if I go back here to my trading platform and I'm showing you here for this particular contract here, my theta here is 1.477. I'm sorry, 1.447, which means that if I buy this contract and I pay $1.71 here, this option contract loses $1.44 every single day. Okay, so know what this means. And if you look at the theta curve out there, the more you go towards expiration, the faster your time decay increases, right? That's why I never buy an option for less than 45 days. Never, because it's losing money. That's the second element of options. The third element I look at is Vega. Vega is volatility, right? You hear something like, the IVR, the volatility, they all talk about the same thing in different terms. Volatility basically measures the sudden increase of price up and down movement, right? It basically measures risk. When the underlying is risky, like Tesla or one of those things, it's very volatile, right? So when you buy an option, look at Vega. If Vega is very, if the IVR is very high, which is above 0.5 really, which is 50%, that means the option is expensive. Okay. Professional option traders out there, when the IVR is around like 25 or below, that's when they buy options. If it's above, they sell options to collect premium. And also, the volatility is very important because once you're going towards the earnings season, as we approach the earning date for a particular stock, volatility will increase. That means options become expensive. If you buy an option right before earning season, after earning seasons, you see the options price start dropping, even if the stock price goes up. Why? Because now there's no more uncertainty. Okay, the risk is gone now because earnings are a binary value, either good earnings or bad earnings. Either way, people no longer care about the stock anymore. Either they're going to buy or sell, that's all gone. Option pricing is all based on that. So three things: delta, your theta, and volatility. Look at those three elements if you're buying options or trading options. I thought I should talk about this before we get into the topic. Now, please stop me anytime. I have no problem slowing things down and talking things in detail. That's what we're here for. We do this every Tuesday until we're all satisfied that we all know what we're talking about. So there's no rush to get this done. So all advanced option strategies involve spreads. Okay. So what is a spread? Well, a spread is used basically to minimize risk, but also to cap your profit. Okay. Let me give you an example of what I mean. I'm going to choose another underlying here. Let's go for, let's say, Apple. Okay. Let's say I want to buy Apple expiring in January of next year, and I'm buying Apple at the 170 strike. I want to buy Apple here. Okay. I'm buying this Apple contract here. If I'm buying this contract expiring in 38 days, what is my exposure? What is my risk? Well, my risk is what I have here, $970. That's my risk, right? What if Apple starts to drop? Okay, of course, you can put a stop, and then stop out. That's fine. But you have to think about risk and reward. How much are you willing to risk, and how much are you willing to gain in return? That's where spreads come in. Spreads are very important because they allow you to trade stock that you wouldn't be able to trade anywhere. For instance, look at Amazon here. Amazon is a very expensive stock. If you want to buy an Amazon option expiring in January, this one here will cost you $12,000. Okay, one contract of Amazon expiring in 38 days will cost you $12,000. Now, how do I trade Amazon? Well, I buy a spread. Okay, you buy a contract here, and then you go ahead and then you sell another contract. This is a spread. Okay, this is what I'm buying. But I'm saying to myself, just in case Amazon drops, the most I will lose is $1,450. It's right here. Okay. However, and the most I can also win is $1,500 as well. So my losses are capped, and so are my profits. This is defined risk reward, right? This is my risk, well known up front, and my reward, if everything goes well towards expiration, 21 days expiration, this is my profit, my max profit here. Now, don't be illusioned. Max profit is never achieved. It's very rare to achieve max profit. Very, very rare. Usually when you're trading options, depending on the stock you're trading, when you are at 50% of your gains, just bail out, take the money, walk away. Okay? Because something can happen. You can have a certain crash or something, some bad news, things are happening, and so your options start losing value. There are ways you can do that by by putting stops there and everything else. You can do that by moving your stop up and down in your position. So spreads allow you to trade large caps, number one, and number two, they allow you to minimize your loss, but at the same time cap your profit as well. If I remove this leg here, I'm only buying Amazon here, and Amazon start dropping, I'm exposed to lose 12K. Should Amazon go bankrupt here, I'm losing $12,000. But if I sell insurance here, this is really insurance, because when you sell an option, you get premium. Okay, I buy this, and this is my insurance here. If Amazon drops below this price and stays there, all I'm losing is $1,400. But should Amazon go up, start going up in price, this is all I can gain, right? Okay. So spread.
Question, Rene.
Go ahead.
If you can go back to your
sure.
trading.
Yeah.
So here you're buying 30 shares and you're selling 97 shares. Is that right?
No. Here I'm buying one. Okay, good question. I'm buying this contract here, which control 52 shares of Amazon right here.
52. Okay.
And I'm selling this contract, which controls 48 shares.
Okay. So now when you're selling, do you need to actually own 48 shares because you're trying to sell?
No, options are you don't need to own on the underlying to buy options or sell options. You don't.
Okay, I thought you didn't need to own for buy, but I thought for selling you need to own the shares. Okay. Not necessarily.
But here what happens, right? Once you buy this thing here, you're selling this. I mean, basically, this here costs more than this one.
Mm-hmm.
And the difference is this.
Okay.
If you have a big account, really big account, you can sell a naked call if you want to. Okay, you can sell a naked call, and then you're exposed to this much loss.
Okay.
You can lose a lot. If Amazon goes bankrupt, you can lose a lot of money. But if you have a big account, fine, you're a millionaire, fine, or do that if you want, but that's risky. So what you do is you buy your regular leg first, and then you sell insurance to protect yourself.
Okay. So primarily what you're saying is you're covering for the sell through the buy that you have.
Correct.
Okay.
This sell here is allowed because you pay more than you collect here.
Okay, got it. Thank you.
That's why it's a debit. You see the DB here? It's a debit, right? If you reverse them, now you're selling more than you're paying to buy. Now this becomes now a credit. Now you're getting money back. Okay, this is a credit spread because you're selling and buying, you get premium back. See that here?
Mm-hmm.
But if you reverse them, now it's a debit. You buying more, you buying high and selling low. You're paying, the difference is that you're paying out of pocket.
Okay.
If I'm bullish on Amazon and I want to trade Amazon, this is what I would do. I would buy at around 50 delta. Actually, the better trade will be, honestly, technically, the better will be here because of the open interest. Okay. If you're gonna trade options, look at this column here, open interest. It tells you where the action is. See this here? Action is here, action is here, action is here. This contract here has very, very little action. Why is that important? If you have a high open interest, that means that contract is liquid. You can get in and out quickly. Okay, so if I'm going to trade Amazon based on this thing here, I would buy this contract here in 3,400 and sell this one over here, the 3,550. This is my exposure. This is my max profit. But if you want to minimize your cost, you can bring it down to here, for instance. Just basically limit your spread here. See, as I go down, this number here goes down. Does that make sense?
Yeah, got it. Thank you.
Yeah, you're welcome. So that's what I'm saying here, right? That's what I'm saying here. A spread, basically, you're buying and selling on the same expiration, the same underlying, just different strike price. You can do it on the put or the call side. If I go on the put side, let's say I am bearish on Amazon, I can buy here, look for the 50 delta, which is over here, buy the 50 delta over here, and then sell 2 or 3 strike outside of that. And then this will be my put option here for Amazon. Now, this is a good open interest contract here. This one is okay because it's about 1,000 contract, which is fine. This would be a nice put option for Amazon. I'm not saying go buy it. I'm saying this is a good example of a put option. Again, because you're paying more here than you get in return, it's a debit. If I reverse them, I'm selling high, then I'm selling high, buying low here. Now I'm collecting money. Now this becomes a credit spread. This concept will come in handy shortly, pretty quickly when we start talking about advanced strategies. Okay. So that's what spreads are. So the vertical spread is just that. This is vertical spread here on the put side, and then I can go here and do the same vertical. This is vertical spread here. Sorry, vertical spread, debit spread on the call side. Vertical spread, credit spread on the call side. Go over here. Debit spread on the put side, and credit spread on the put side. Right? Now, one thing I need to cover here. If I'm buying this option over here, the 3,300 contract, look at my theta. Every day I'm losing $156 on this contract. Okay, I'm losing $156 every single day. However, if I go and buy insurance, now I'm only losing $1 a day. This also limits my, this almost cancel my time decay. This is how you control theta. Spreads allow you to basically cancel time decay and also cancel delta. You become delta neutral and also time, basically time, insensitive. You only now worry on the, you don't care about the price action. Remember that spreads allow you to cancel time decay, or almost cancel it, and also almost cancel delta, just to not rely on price action. That's what I'm saying here in so many words. All right, so let's go to the, that's what I just explained there, that if you buy a naked call, if you buy a naked call for Amazon, for instance, this was last week, you buy this option over here. Well, this is your theta exposure over here. This is how much you are, sorry. This is how much you tend to, gosh, this is sensitive, sorry. This is how much you tend to lose should things go completely wrong on you, right? The naked call, this is the exposure. Sorry, this is time decay, exposure. But if I go for a vertical spread, this is my time decay, almost nothing. And this is my exposure, which is limited. But also cap my max profit. Trading option, in fact, in general, trading is about risk reward, right? It's about, basically risk management. Manage risk properly, you will trade well, whether you're trading stocks or options. It's all about risk management. Here, this is how you manage risk by trading options. Either you buy a naked option and then you stop out, or you go buy a spread, then you can stop out on the underlying or something, or on the price. It's up to you. Okay. Now, let's talk about a long debit spread here. That's what I was talking. In general, here, this is what I do in my own practice when I'm trading options. If you're gonna go long on a spread, whether it's call or put, always try to buy your long leg around 0.5 delta. Remember, the long leg is what you buy. When I say long leg is what you buy, and the short leg is what you sell. Okay, remember that. Here, this is your long leg. This is your short leg. Okay, so your long leg should always be around 0.5 delta. Now that is in general. Now you can make adjustments. Like in my case, I care about the open interest. For this particular contract here, for Jan 21 next year, this contract here at 0.5 delta doesn't have a lot of action there. I don't like it. So what I'm going to do is I will go a little lower and buy my long leg around 3,400 strike, which has a nice open contract here of 4,400 contract here, right? Which is good. This is very good open interest. Now the short leg here, I don't really care because even though there's not a lot of action here, if I'm making money, I'll get out because Amazon is very liquid stock. If you have enough money in your portfolio, then this will be what you should do. You go here. But in theory, you should go 1 or 2 strikes outside. You go here, buy here, and then sell here or sell here. That is the textbook definition of a debit spread. Again, you have to adjust as depending on the situation. Now, because it's a long debit spread, you have to have a bias. That means that you are bullish on the stock. Because if I think that Amazon is going up in the next few weeks, I can buy a naked option, which is this here. I'm buying a long option, and then I'm risking $11,000. Or, okay, you know what? I'm not that greedy. I don't manage my risk. I'll just sell a short leg for protection, and then I limit my exposure, but I also cap my profit. Okay? Because think about it. If you buy Amazon at this contract here, and Amazon goes up to only 3,400, let's say 3,440. Okay, let me just I need to. How do you do annotation with this thing? I'm going to do some annotation here. How do you do that? Oh, forget it. Working. So if you buy this contract here, and Amazon it goes all the way to 3,440 and stops here. That's your profit margin. Okay. So why risk that much money only to make like $40 on per share here? I could have as well just sell this, make the same profit, but by risking less money. Remember, it's all about risk reward. If you manage risk well, you will do well when you're doing investment or doing trading, right? So that's what I'm saying here. If I'm going long, choose a good go at least 45 days here. Let me explain this in a second. The rule of thumb is go at least 45 days. However, do not trade weeklies. Weeklies are not liquid. Let me tell you what I mean. You see all these W's here? These are weekly options. I only trade monthlies. This is a monthly one here. This is another monthly here. I don't trade weeklies. Look at weeklies in the open interest. Not interesting at all. This here is just gambling. I go to the next month, which is 38 days here or close to it. And by day 21, I need to get out. So I will trade this one or go to this one over here. I won't trade a weekly. I simply won't. I'll just go to the next contract, which is 66 days out. Because why are we doing that? Because of this. We're trying to minimize time decay and give ourselves a chance to be right in our hypothesis of our trade. Okay. So your strikes, don't make them too narrow. Now that depends, by the way. For a company like Amazon, which has like $100 strike in between, this is okay. You can buy here and sell here. This is called an in and out spread. Basically just like it's it's very good side-by-side strikes, which is okay, right? But if I'm trading something like Boeing, and I go in there, see that I mean here, Boeing has like $5 strikes. If I buy here, I'm gonna sell here, give myself like a $10 wide strike. This is not interesting. This is right. This is what I would do. And for this particular spread here, I'm risking 345 to make 655. That to me, that's
quick
like
question here, Remy.
Yes, go ahead. Go ahead.
So in this case, since you're buying the 200 call option, right, and you're also selling the 210 call option, as the
Yep.
price increases, right, obviously the 200 call option, your value is going to go up, right? But it's also going to decrease the value of the 210 because you're selling that, right?
Yes.
So how does this compare with like just regular buying, right? Like just naked option buying. How does the profitability compare, right? When something goes from 200 to 210,
Oh,
just
no.
naked option versus spread.
When the price increases, this option also increases in value.
Oh, right. Yeah.
They both increase in value. Now, the good thing about a spread is, let's say that I mean that the stock breaches and then ends up here at 220. I don't care. I have protection with this. They're both in the money. I'm good. Okay? They both increase in value.
Got it. So is there a quick way just to compare what is like naked call buying versus like a spread buying, just to see what is the profitability difference in both?
Okay, for the profit in theory is infinity, but that's not true, right? It can go as high as the stock goes, but it's not realistic to think that I mean things will go up forever. Infinity doesn't exist. It doesn't exist at all. In fact, the odds are the stock may go back down on you. When you buy, when you put money to work, whether you're buying a stock or buying an option, don't look at the upside. Look at the downside first. What is your risk? What is your exposure? Here, your exposure is what? It's 145. Okay? Mm-hmm. By capping it, now it's half of that. I'm making money. But if the stock goes to 220, this is all I'm making, 655. Whether the stock goes to $1 million, this is all I'm making. That is the downside of spreads. You cap your profit because you risk less to make less. If I remove this leg here, I bought a naked option, and then the price goes to $1 million, you're a billionaire, no problem, you're rich. That is the best case scenario. All right? You get all the reward, but you also have all the risks in there.
Got it. So in this case, if it moves from 200 to 210, then it would be like 10 into the delta. Is that correct? The profitability?
It is $10. You made a $10 a share that you've made. Then do the
in 200, right?
Correct.
Got it. Yeah. Thank you.
10 minus 10 minus the premium paid.
Got it.
It's basically 200 to 210, right? Is 110 minus 740. So it be a 103.55 because you go remove the premium paid, right?
Yep.
To win the money.
Correct.
Yeah.
Thank
you. So you choose, right? You choose risk reward. What do you want to do? What is your you want to risk everything to make a lot of money, or risk some to make enough money but know how much you're losing up front? Because when I'm investing, I need to know exactly what is my liability is up front. If I buy a naked option, I always put a stop. Always put a stop. Because if I stop out, I'm done with that option. I'm done. I'm out. Because people really sometimes. Let me take this second to talk about a trade plan. Okay.
Coach, I have a question.
Go ahead.
If you could add the sell back there.
Yes.
So now it's showing that the max profit is 655. Is that right?
Correct.
And then it has a theta of 1.759. So does it mean that I'm going to look, if I let the option expire in 38 days, that is what this is for,
Mhm.
I will lose 38 into 1.75, and the rest is what I'll get out of the 655.
Correct. Every day you lose this much money, and depending where the stock ends up, remember there are many things that are happening, right? There are also Vega that's happening out there, that kind of stuff. But everything being equal in a perfect, mathematical formula of an option, every day you go in. If you let's say the stock price goes to 215 here, right?
Mhm.
Over here. If you go to expiration, you made 110 minus the premium, and then you've lost like $1.75 a day.
Okay.
That is the theoretical loss, the theoretical daily loss of the. In fact, this will actually increase towards expiration. By the way, it will increase. It won't stay. This is the minimum loss every day. It will go up, but not by much, because it's a spread.
Okay. So ideally, you won't wait until the 38th day. You will sell it before that.
I always tell my clients, close the position 21 days out.
Okay.
Yeah.
21 days before expiry.
Correct.
Okay.
What do you search for at that time? What do you look for? I mean, 21 days or around 21 days? Or what do you do? Can you what do you look for to say, okay, now it's time to get out?
If I have made money before that, I'm out anyway. If I have lost money, I'm out. Whatever happens, at day 21, I'm out. It gives you time to save some of your premium. Remember that options by definition are decaying assets, right? Every day they lose money. Every day they lose money. Let's say you buy this option here. You bought let's say you bought a 215 call, right? This one. And by some magic, Boeing stays at this price for the next 30 days. Well, this thing will expire out of money, then you lose everything, right? It will expire worthless. Because if Boeing doesn't come towards your contract strike, you lose everything. We agree. But by closing your position at day 21, you save a lot of your premium. You do. So my rule of thumb is, if there's a price drop where I've lost half of my premium, I'm out anyway. I'm out. Done. If I'm in a trade, the trade is going well, whatever I have made in profit day 21, I cash out, I move on. Some people, if you buy now, if your goal is to exercise an option at maturity, then you can stay until expiration if you want to. Okay, fine. But why do we even exercise an option unless it was a protected put? It makes no sense. Unless you sold a put, so that, I mean, you can buy the shares at lower price, sure. Otherwise, don't exercise an option. It doesn't make sense. Just sell it and then go buy the shares in the open market.
Rene, when
Yes,
when you sell a put, I mean, essentially you need to have enough money in the account, right?
correct. Capital, yes. Mm-hmm.
Do you need the same when you buy a call?
Okay, that's a good question. So let's talk about that for a second, right? When you sell a put, what you're saying is, if this option goes to zero, you have enough money to cover that loss.
Mm-hmm.
Correct? If I do this, if this becomes a sell here, right?
Mm-hmm.
And then actually, let me clear this one here. Let's go back. This is a January BA. I'm selling. Sorry. I'm selling this 200 put here, right?
Mm-hmm.
Look at my max loss,
Yeah.
right? This is the
The
max profit.
full amount, yeah.
Okay. Now this account is frozen. Shoot. Now, so basically, yeah. So you should have enough money. That, I mean, if things go wrong, that you have enough money to cover that over here.
Right.
That's why I said earlier that, I mean, if you have a large account, you can sell naked puts all day if you want. You can even sell naked puts all the time.
Mm-hmm.
That is the whole point of the cash secure put, right? That's the concept of cash secure put. You sell a put, and then thing goes down, then I mean somebody will assign you, and then basically you buy the stock at a lower price. You get
Right.
assigned. You get assigned. Yes. By the way, if you are on the short side, you get assigned. If you're on the long side, you have to exercise. That's how it goes.
Hmm. And like, how about like when you buy a call?
Mm-hmm.
Do you still need to have that money?
Yes, because it's like buying a stock, right? This is what you pay. If I want to buy this call here, I need to have this much in my account.
No, you're paying the premium, but in your account, do you need to have, the full amount of the strike price and times 100?
No. That is the beauty of options. That's why they call leverage instruments. You
Mhm.
only, when you buy an option, you don't own the stock. You only control the stocks.
Hmm.
This one here controls 45 shares of Boeing. You don't own them. That means you don't get any dividend. You don't get any dividends at all.
Mm-hmm.
If you basically, it's like this is why options are such a rigged game. Let me say this to you. Every contract company out there has a defined number of shares in the open market, right? Every company, whether it's Boeing or Amazon or Tesla, they have a very well-defined number of shares that is out there in circulation.
Mm-hmm.
Now, I want you for a second to look at this thing. These are all the contracts up until January 2024, okay? And each one of these contracts controls 100 shares. There's no way that Boeing has enough shares to cover all these contracts, right? That's why when you buy an option, the market maker by law should go ahead and secure 100 shares of let's say in this case here 45 shares of Boeing, but they're not enough shares to go around.
Mm-hmm.
That's why the SEC allows them to do that. They get away with murder. They don't have to own the shares and basically to as leverage, but they have money in case something goes wrong to cover your contract. Now, remember, when you sell when you buy a contract, somebody sold it to you.
Right.
Okay, the market maker is just in the middle to make a buck. I mean, he's a middleman. But sometimes the market maker is greedy. He'll buy it for themselves. Okay, but normally for everybody there's a seller. So if you buy this contract here, you're not buying 200 shares. You're not buying 45 shares of Boeing. No, you're paying this much money for the privilege of controlling 45 shares of Boeing. If Boeing goes up, guess what? You make bank. That's why you risk less to make more.
Mm-hmm.
Me, I only trade stocks in my kids' account. My own account, my personal daily account, I only trade options because trading stocks is very capital intensive. Imagine buying 100 shares of Boeing, right?
Right.
Today, the closing price was $195. This is $19,000.
Yeah.
Versus paying $745 to control the same amount of shares. If Boeing goes from 195 to 205, guess what? I made money by risking less.
Mm-hmm.
That's why
So,
options are powerful.
So in this case, like, I mean, if you have bought the call, at I can't see the number, the 200, and like, let's say the price, the stock goes down, let's say to 170, but you're still held up for buying it at 200, correct?
No. When you buy a call, you don't have any obligation. You only have the right.
It's a right. Sorry, thank you for saying that. When you buy an option, you buy the right. Whoever sells it to you has the obligation. The seller is obliged to honor the contract. You, the buyer, has the option of either selling it before maturity or exercising it if you want to, if you're in the money. You have the right to do that. But the seller must honor the contract. That means if you sell, okay, let's go for instance, let's say you sell this, right? if you sell this naked option, let's go here. Let's say you sold this contract here, then you collect 81 cents.
Mm-hmm.
If the strike price, if the option price goes to 235 here, now this thing's in the money, correct? If this thing goes to expiration, you will be assigned. That means you have to buy this option at this price.
Right.
Okay, that's why selling option requires you to have a large account, and it's a risky strategy. But I tell you why people do it. Okay, but normally people like me, I mean, I sell premium too, but I tell you why I'm selling it when I'm selling it when we get there. But most people, when they start trading options, they buy call, they buy puts. You know, instead of buying stocks or shorting stocks. If you want to go long on a stock, instead of buying stocks, you buy a long call. If you want to short a stock, you buy a put.
Mm-hmm.
It's cheaper to do that way.
Mm.
So now options expire, right? That's why you should give yourself enough time. Give yourself like 45 days at least. You know.
Yeah.
Yes,
So
that's-
when you buy the put, I mean you are actually paying a premium, and
same
you
thing
know
here.
you want to buy it at a lower price than
Yeah.
what the stock is.
No. Okay. If you buy a put, that's a good point. If you buy a put here, and then let's say I bought a put here at 170, let's say 165, right? And then the stock drops to 165, right?
Mm-hmm.
Technically, you have the right to buy those shares at that price by
Mm.
exercising your option.
Mm-hmm.
But exercising doesn't make sense because you got to pay a fee to your broker. You're better off selling the option and buying the shares in the open market with that money.
Mm.
Okay, I would tell my clients never exercise a long option. It's not worth it. Sell it, get the cash, and buy the shares in the open market.
Mm-hmm.
You're not paying commission.
Can I add something here quick? When I started off, I was confused as well with this call and put, right? So, and the right to buy. So when you're buying a call or buying a put, it's you don't need the money in your account to actually buy 100 shares or sell 100 shares, right? Because you're buying it, you're buying something, you're buying an asset. I mean, at least in your eyes, that's an asset. Yeah, you're buying a contract, right? But if you're selling a call or selling a put, that's the time for selling a call. You need the collateral in terms of shares because you are selling a call against your shares. And when you're selling a put, you need the collateral in terms of the money, because if the price reaches your strike price, then they will make you buy the shares. So when you come to the selling, part, you need your account to have that much money. But when you're buying something, you've got something in your account to sell it back to make money, right? But when you're selling something, you got to buy it back to neutralize your position, right? So think it that way. I think that'll help.
Yes, when you're selling a contract, you must have something to back it up, either cash or position that can match your whatever your exposure. You can have shares to match against what is. Okay, let me go back to the call here for instance. Okay, let's say in my account I own 100 shares of Boeing. I can sell a covered call. This will be a covered call. I can sell this call, which is covered by the stocks. That's why it's called a covered call. Okay. If I have 100 shares of Boeing in my account, I can sell a contract on Boeing because that contract is covered, i.e., collateral in my account by the shares I own. Or I can have a lot of money in my account, or I can have a long option, which is worth more than this short option here to cover for that position as well. There are three cases for that, three scenarios. Either I have stock to cover for the short call, or have cash as collateral, or I have a long option which is worth more than. For instance, I can do this as an example. I can do here. This is an example of what we do see there. I can go here and buy this thing here. See, I'm buying this here expiring in April 2022, right? And then go here and sell something like this If you see here, I have, this is called a calendar spread. Basically, I'm selling the spread here, covered by my long position here. Buy to open and sell to close. You can do that. This is legal. This is very legal. But the question you were asking me here, you can never try to, I mean, let me go back to my monthly option here. If I want to sell this option here, I have to have money in my account of shares of Boeing to cover that. Does that answer your question? Otherwise, let me know so I can try to find a little way to explain it. Anybody?
Coach,
I think Rahul was just explaining in different way. I think we can move ahead.
Okay, good. All right. So that's what this was. We just want to talk about a long debit spread. Basically, you're buying a spread because you have a bias. You're either bullish or you're bearish. If you're bullish, you buy a call. If you're bearish, you buy a put. That's that. Okay.
Coach, I have a quick question on the slide. Can you go back to the slide?
Sorry. Yeah, go ahead.
Yeah, here on the second point, you're saying buy one strike in the money at 50 delta. And then next one, you say sell one or two strikes out of the money. If you sell two strikes, will one of them become naked?
No. Let's do that. Oh, I don't mean two contracts. I mean like, okay, I didn't mean two contracts. I sell. What I meant was you buy here and then you go.
Okay, I got it.
The difference in the strike price.
You go two steps. You know what? That's a good point. I'll fix that. I don't mean a contract. I'm saying go two strike out of the money right here. That's what I meant. This is what I meant. This or that. That's what I meant. Buy in the money and then sell two strikes out of the money.
Okay.
Yeah, but if you are buying, like if you're trading with the SPY, it is $1. Sometimes it's
exactly. Let's go to that's a very good point, Mary. Let's go here to SPY here. It's a dollar strike, right? It's very good. So that's why you should always go. You do this, and then you go like way like maybe like 10 out, something like this. That's why I said here, don't make them too narrow.
Right.
Okay. So basically, because SPY is very liquid, it's dollar per strike. So you go 10 out, or whatever you want, or 20 out. It's up to you how much you want. It's how much you're willing to bet, right? And then how much you make it. It's up to you. Personally, I don't trade the SPY. I trade the SPX. This is better to trade than the SPY. It's very liquid. No matter where you go, it's very liquid instrument. And as you can see in there, it's like it's almost like a large cap. But see, this is like 10 wide here per strike. One of these is worth 10 SPY, by the way. One contract here is 10 SPY, just so you know. Okay, so
Coach, how do you determine like low IVR?
okay, so IVR, that will take me to what I call barchart.com. Let's go here and look at, for instance, like I don't know, Tesla, for instance. And go here in my volatility, in my Greeks. Okay. If you go to the Greeks here for Tesla, see right here, this is my current implied volatility here. And here, and this is my historical volatility over here. Okay. These terms that I mean, historically, this has been the volatility of Tesla. Right now is high. That means right now Tesla is expensive. This is way high anyway. Now, to your question, my platform TCWalk has the IVR rank in here. The IVR rank is here. See this little column here? The IV touch right here. See that? It tells me my profit. Sorry, let me do this here.
But here it is in percentage, right?
Okay, the IVR is a percentage. This is right here. But you can do that, or you can go here, look at this as well. It basically gives you the same information, but different way of showing it. In my rule of thumb is anything above 50, I don't touch too much. Okay. If you don't have the IVR on your platform, go here and then you get it. Use this one here.
Got it. So if you're just using this IV, then we look for like less than 50%. But if we look for the percentage, the IVX number that you showed in the Tastyworks platform.
Yeah, right here.
So here, is it also 50%?
Here is here is the touch. What are the probability of touching here? This is the touch, but the IVR is right here to 1% for SPX. Let's go to Tesla. Let's see. See here, it's almost the same, right? Almost the same.
Yes. Got it.
Almost the same. Casey has all that for you, but if you don't have it on your platform, you just go to bankchat.com and then you get all this stuff there. You have data and Vega, they're all in there, and Delta as well. Okay. All right. So where was I? So we talk about the debit spread. What you should do is spread. Let's go. Very quickly, we talked about this already. This is basically, I don't really look at this thing here. Is like, it tells you how much. Basically, you're capping your profit, right? If I can show you what this means in a picture, if I go here again, let's say I'm buying here and I'm selling here. My strikes here are here. The low strike and the high strike are right here. Okay, they're right here. And all I'm saying is that, I mean, if I go below here, it's basically my profit and loss are capped. Oh, sorry. But that's all this is saying, right? This is the profit loss. It doesn't matter what, if the stock goes to infinity, your profit is capped by what? By this spread here minus the premium. This is the profit here for this particular stock. I don't like these pictures more because they can be confusing. I like showing it just by showing the picture over here, like this. And this is my curve. I can show the same thing on the curve. The same curve over here. This one shows squares, but this is the same thing, right? You have this line here. This is your loss line. This line here is your gain line. And your strikes are basically these lines here. I can move it around a little bit like this, make them wide. These are my low and strike prices. This is basically what I'm doing with my analysis tool on Tastyworks. It's the same thing I'm showing. Basically the same thing. Okay. Okay, so the bull call spread. I'm bullish. I'm buying a call, a vertical spread on the call side, right? If I'm bearish, we said earlier that, I mean, for the case of the bear case, I'm flipping it. I'm just buying and selling, right? That's what I'm doing here. So this is my put spread. This is a long, but it's a bear because I am banking on the stock to go down, right? Remember, you put makes money when the stock goes down, and they call make money when the stock goes up. And this is my bear call spread. Sorry, what am I saying? Apologies. Bear call spread on the call side. This is a bull call spread. Okay. Sorry, my apologies. This is a bull call spread. Why is it bullish? Because I want the stock to go up. This is the bear call spread, where now it's a credit spread. Okay. This I want the stock to stay down so that it doesn't breach my short strike. When you do a credit spread, you want the stock to stay below your short strike. Then you keep all your premium, because if the stock comes, let's say you're here, right? If the stock breaches your strike here, you're in trouble. That's why if you want to sell, if you want to do bear call spread go way out around like 0.5 delta. Really go way out here. Way out, really go way out. This is what I mean. Now, on Tasty platform, this line here tells me the probability of my move. This is called the expected move, right? Based on their own private math and whatever they know, it's saying that, I mean, if all goes according to plan, Tesla can go up to here or drop here, depending on what happens. This is the range of Tesla from here to here for the next 24 days. So if I want Tesla to to touch my short strike, I will go make it here, collect $2.30, $230 in 24 days. I'm safe here. So the bear call spread is bearish. That means you want the stock to go down. That's why you're selling it here. As long as the call doesn't reach your short strike, stay. What happens if the strike reaches your first strike? We talk about it in the first slide. It's called managing your trades. Again, if I show you this picture here, it's the same here but reversed, right? My profit now is here on the left, loss on the right. Profit here, loss here, and then my strikes, I can move them all I want, right? Then my strike. Same thing. Low strike is the high strike today. My low strike is my high strike. Okay. Okay. Good call, bad call. Now, for the put side of things, again, you're going to ask me, why do put instead of doing calls? It depends. If normally, I mean, the premium on the put side are higher than the premium on the call side. When the stock is dropping, the puts become expensive and the call becomes cheap. And when the stock is going up, the call becomes expensive and then the puts become cheap. If I'm selling premium for a stock going up, okay, I want to sell it to collect the most premium, but also be defensive. If a stock is dropping, I want to sell. If the stock is dropping, and I make money in that on the put side, I will buy puts. But if the stock is going up, and I want to make money, I will sell puts. If I sell a put here, I will do. This will be a put. This will be excuse me, a bull put spread, because I'm bullish, because my short strike is here and I'm collecting premium and I want the stock to go up. See that? I mean, I keep my premium, all of it, and then my short strike doesn't get rich. Rule of thumb, whenever you have the short strike close to the stock price, it's always a bullish scenario. Okay? No, it's always a great scenario. You try to collect premium. So you're selling high, buying low. Selling high, buying low. Okay? So, bull put spread is this one here. I'm trying to make money. And then the bear put spread is when I want the stock to go down. That's when you go for a long put. Sorry, a long a put credit debit spread. This is debit spread. Okay. If I show you this picture here, it's the same thing. Green here, red here, green here, red here. My short strike is here, and then I'm taking a long strike is over here. Okay. And you can play with this thing all you want. By the way, sometimes if I'm trading, I play with these numbers here to look at my probability of profit here. See this number here, POP? It tells me the odds of me making money on this trade. I just move these things around, to find my optimal trade through my analysis. That's how basically I do my trading sometimes. Any questions? I know I'm going fast here. Please stop me.
So So when you say bear put spread, it is basically what is the difference between credit put spread and bear put spread? Are they the same?
No,
Debit put
the same.
put spread, right?
They're not the same.
Yeah.
This here, this is a bull put spread because I'm long and short. If I reverse them, sorry. This is a bear
Correct.
spread because I want the short to go down, right?
Yeah.
Even when someone must go down, but in the bull put spread, I want the short to go up.
Yeah.
Because I'm collecting profit. See, I'm collecting premium over here. I will sell this spread to somebody out there, so that I want the stock to go up to stay above my short strike. Yeah, sorry about that. Sometimes those things misleading.
Yeah. No, I do the same.
All right, cool. Thank you.
Yeah. So this POP is probability of profit, right? Is that
correct? Yes. Yeah.
So I don't know whether is it there in Thinkorswim?
That was my question, Nari. Because I know if you do the review, you get the little small window that tells you the maximum profit and loss and stuff like that. Does it show this also? I don't know. So yeah.
I don't know if Thinkorswim have it. I don't know. I gotta check that. I don't know.
Coach?
Yes.
Hello?
Yes, I'm here. Go ahead.
Yeah, your green one here, that is a buying put or that's a selling put?
Aha. This is buying, this is selling.
Yeah.
What's that? You buy here?
I buy here and sell here.
Buy here and sell here. Okay.
Yeah, that's why it's a credit spread because you are making
spread.
money.
Okay. Because I want to collect profit up front. Okay. And I want the stock to go up. And then I do a bull put spread. Now these credit spreads are very dangerous. They're very dangerous because they have a very high capital requirement. This is my max loss. My max loss here, but really, I need more than that. For this one, this account is frozen. I would have chosen certain things. Okay.
No, I think this is bear, right? This is not bull.
This here is bull.
How? Because
remember, I'm on the put side.
Yeah.
I sold short. I'm short to long. I'm short here and long here.
Okay.
I'm collecting premium. If the stock stays above my strike, it goes up this way. That means the stock is going up, right?
See, when you are selling a put, then you are committed, right? You have an obligation to buy the stock, right?
But the question is.
So even if the stock goes up, you are still committed to buy it at a lower price.
Oh no, but this is a spread.
Not for the put.
Yeah, if it goes out, you're not obligated to buy because no one would sell it at a lower price to you when the stock price is like say $1,000, right? No one is going to sell you at 930.
Right. Okay.
Yeah. If the stock price goes below 930, you end up buying it at 930. That's what Nari is saying.
It will expire worthless. If the stock price is above 940, this spread will expire worthless, and I keep all the premium.
No. See, if it goes to say 900, right? Then you are obligated to buy.
You have to buy.
Yeah.
Correct. You have to buy. Yes.
Yeah, that's right. What he's saying is you expect the stock to go up, not go down. That's why he's saying if you think market is bull.
Correct.
Exactly. My bias here is I'm bullish on the stock. Because I am bullish.
Yeah.
I am selling this credit spread to collect premium.
Yeah. Premium. That is why your maximum profit is the same as 15.10.
Correct. Exactly.
Times 100. So that is the only premium is the only money you are going to make there.
Exactly. And my loss is
going to participate in any stock appreciation.
Exactly. Well, this is the most I can make. But my loss is the difference here in the strikes.
Coach?
Yes.
But if you are confident it's going to be bull, it's going to go about 930, you don't even have to buy the put. But the buying put is just the insurance in case it goes down. Am I right?
The thing is, the cash I need for that becomes very, very high. See that? 35 grand. If I sell this put for Tesla, I need to have in my account $35,000 only to cover this put. You see that here? This is my capital requirement.
That is because of margin, right? Actually you need 88,000.
That's the margin here, and this much I can lose.
Yeah.
Okay.
Right.
That's why I need insurance. That's why I don't trade naked options.
So if you translate to Nanban strategy, what is described is exactly same as level 2 strategy in Nanban.
Exactly, yes. So what I'm saying, coach, is if you're so confident it's going to be bullish, then you don't even have to buy it losing the premium.
Sure.
The reason you're buying it is just to, in case it goes down.
Yes, absolutely. But this is a marketplace, right? You're never that confident. You don't know. It's never 100%. And remember, trading is about risk management. Never forget that. Never forget that. Always have insurance.
Okay.
Either by stopping out or by capping something.
Okay.
And never trade naked, ever.
Okay.
If I buy a stock, I will stop out. Maybe it's the long-term stuff. If I buy an option, a naked option, I put a stop loss there.
Okay. Right.
Or I buy a spread or sell a spread.
Okay.
Because me, I'm very risk averse. That's how I minimize my losses.
Coach, normally, like when you place the orders for, the buy or the call, or the put, I mean, essentially, do you go with market price or do you change it to a limit price?
Here, the good thing about testing is that, testing will take the bid and ask divided by 2 and then give you the mid price right here. See that here?
So you just go with the mid price?
I always go with mid price, always.
Oh, okay.
Yeah. This will give you by the now. That's a good point. Some platform like I think Webull and I think Robinhood are very bad when it comes to pricing. They're terrible. They're terrible when it comes to pricing. Be careful with those.
Yeah.
This will always give you the mid price. Now, if you know that the stock is tanking, you can even lower that if you want and wait.
Mm-hmm.
Because you know that the stock goes up and down all day, right? At some point it'll go down, and then it'll hit your price, and then you buy it at that price.
Mm.
If you're in a hurry, if you want to get filled right away, you go to mid price.
Oh, okay.
Yeah.
Coach, can you show a simulation where you have this this contract for like 40 days, whatever, a month out, whatever, something, and then when you close it out after watching a profit? Is it possible to do that? I mean, if it's out of topic, that's okay for right now. So yeah.
No, I don't think you can do it with this. I think you can do it with Thinkorswim. No, with this, I think. Because what you're talking about back testing here, right? You can't back test with testing. You can't back test with testing. Yeah,
I think there is an analysis tab which allows you to do that.
Yeah, but analysis tab here basically gives you this, right? Basically,
no, the analysis tab.
Yeah, this is well. You mean like go to here?
Yeah,
this,
yeah.
You know what? I never spend a day on this thing here. I spend my time here. I stick here, but this is actually a good time to look at. I mean, I don't even know how to read this analysis tab. Maybe that's a good point here. It tells you where you may end up, in terms of profit. I think, right? You can move this guy here. Oh, see this thing here? Look at my cursor. Tells you
candlesticks, right? Yeah.
No. The cursor tells you exactly how much money you're making in theory, right? As you go into expiration, right? Tells you. See that? You see that how the price changes? And if I go down this way, I'm losing. See that? When price goes down. Is that what you were asking? I'm not sure.
Yeah, but this is not backward testing. This is just price variance analysis.
simulation. Yeah, just yeah.
You know, backtesting. I don't know because I don't think it has
So
that.
you can simulate different scenarios, different prices, and see what is going to be your profit.
Right. Anyway, but I mean, you can go to option. What is that? I think it's called option something. Option calculator. I think option calculator.com. I think it's out there. There's a site for that. That tells you all these things. The option profit. Yeah, this side over here. I don't know how to use it, but it's there. Let me show you the site. You can go in here and then I think is this the one?
Yeah, this is the one. The
Yeah.
option profit calculator.
You can go do. I mean, you can go do these things here if you want. But I don't know how to use this site. I look at it. I know, but it's happened. I never used it. It's a good site to use actually.
I can help you if you want to quickly show something.
Sure. Yeah. Absolutely. So how does that work?
Let's just take a normal normal call. So go back one page. Like go back to the home page.
Okay.
We just do a simple long call. That's all. Just a very simple long call.
Okay.
So yeah, long call. So that's bullish. We want the price to go up. So click on that. Let's go symbol SPY.
Okay.
It should auto-populate the current price for you. All right. So we're going to buy the call, and then click on that select option button. Yeah. And then let's just choose something on the top. There are the expiration dates. Choose something.
Let's go here for instance.
Right on the top. Yeah. Let's say 18th February 2022. That's fine. And let's take something which is out of the money. So if 490.
Around the 490.
Yeah. Anything more than 468. That's fine.
Okay.
All right. That's good. Now just say I agree to the terms and condition, and just say calculate.
Okay.
So that's your price of the option. So before you say, okay, the price of the option was $4.44 today. And that actually simulates based on how the price of SPY moves and what's your option value. So if you scroll down, Coach, a little more. Yeah. So you see that chart values, there are these three little boxes. Yeah. The last box. Instead of percent of maximum risk, can you put the drop down there? Yeah. Select spread value, the last one. There you go. Yeah. All right. So 18th December or 15th December, which is tomorrow, right? Because the trading day is over. The current prices are, I believe, 468 something, right? So right now you paid $4.40. If on say January 14th, the price of SPY goes to 505, you would basically go row 505 Jan 14th. Your price of your option would be $24.07 times 100, which is 22,407. And so it actually shows you what the value of your option is going to be at which date based on the price of SPY. You can do this with spreads as well as puts and calls.
I'm going to spend time tomorrow and master this. You know, I've never used it before, but I knew about this page, but never used it. Oh, thank you. This is not, see, I'm glad. Thank you so much. Appreciate that. This is awesome. I knew about this page, never used it ever. Never used it even once.
It gives you a good idea on sometimes.
Yeah,
and also,
yeah.
What I've noticed is that, some people think that the higher the price goes, your option value will increase.
No.
Longitudinally. It doesn't. After a point of time, what happens is if the price of that share or stock remains constant state till expiration, your value doesn't change a lot. It actually only changes with the price. Then it like stabilizes after a point of time, and that's something which is very useful looking at. Like visually looking at this chart, it really helps you out here.
This is beautiful. This is like symphony.
Yeah, and it also has the percentage of profit that Dinakar has.
Yeah, I'm telling you. Oh man, see, thank you so much. You have no idea. This is exciting now. Tomorrow, I want to spend the 2 hours with this.
And just a quick note. I don't know if people use a lot of Robinhood, but it has a nice, like at least the mobile app has a nice tool where you can see, what your profit's going to be. It's a nice little tool which you can play around with to see what your profit is going to be. Yeah, on Robinhood. On Robinhood.
Oh,
before, yeah, like a preview tab. Yeah, like the preview tab.
I don't know why I hate Robinhood with a passion.
Yeah, I know.
I hate that too with a passion. It's like a video game. You can't short the stock.
True.
I mean, you can only go long. You can't short a stock in there. I mean, anyway, excuse me, but Robinhood is not my thing. But Oh no, this thank you so much. This is beautiful. I will spend time studying this thing. I've known this thing for years, but never really took time to go study it. Never.
And it does give you the probability of profit right there. Someone asking for that, right?
Yeah, right. It's right here. I mean, this is beautiful, man. Thank you. Awesome. See, we're talking today. Thanks. Okay, credit spread. We were talking about that earlier, right? So when do you do credit spread? When you are in a high IVR environment, usually like around earnings, right? Options are expensive. When you're selling something, you want to sell it at a high price, right? And then high IVR is good for that. Of course, 45 days. Now, with any credit spread, right? Every single day. Now let me show you something here that I didn't show earlier, which is good to show, right? Let's go back here. Let's say I go out 45 days. Let me test that. Let's say 38 days, and I put a credit spread here. This here tells me how much money I earn every day. Okay. Remember, like on the long spread, I was losing. Now on the credit spread, I'm gaining because I am on the sellers. I'm on the selling side now. If I sell this spread here with 38 days out, this is how much I'm making every single day in terms of profit. So this is not a good credit spread. I should make it away from the stock price here. If I'm here and then the stock price stays around here for this is how much I'm making every single day, which means that after 10 days, I can cash out. That's the beauty of credit spreads. Every day, your position makes money because you sold something which occurs money every single day. Now, upfront, you get this, you get this right, but every single day, the buyer of your option loses this, so you can buy it back and then keep the difference. Does that make sense to everybody? This really has to make sense to you. When you credit spread, you get the money up front in your account. But each day goes by, options basically goes down in value for the seller, but for you, this is how much you're making every single day. If you go to expiration, you make the max profit, but who wants that? Nobody wants that because it goes to zero, right? For the buyer, you want to look at it every single day, okay? So this is good for, like I said, if I know for a fact that Tesla is going to go up, but I'm being cautious, I'll go sell do this at this price here. I'll go somewhere around here and then collect like almost 9 grand, right? And then wait slowly. But should Tesla, strike? Should Tesla come down to my price? That's a problem. We'll talk about it in a second. How you defend against that. So we talked about credit spread and debit spread. And I'll give you some numbers here. These are basically the things that all the pros will tell you to use. The long strike at 20 delta, the short strike at 30-35. If you're trading Tesla or Amazon, Google, be careful. Those are very high ATR stocks. Be very, very careful with those. Okay. And when do you get out? When you've collected half of your max profit. What does that mean? When you've collected half of this price of this thing, you pay back half, you keep half. When you open the position, you get this money in your account. After 21 days, or after you earn half of the premium, you buy it back, you pay half back, then you keep half. That's what it's saying here. Never try to go to expiration. It's a bad idea. Okay, 1 is of 50% max profit. You get out. Okay, I have this thing here. I will leave this slide up here so that I mean when you watch the video again, you can spend time on this one. It gives you, the conditions as to when to use what. It's very important to know when to use which strategy based on the market conditions, right? High volatility, low volatility, earnings, is it like was it like a gap up, gap down? Is stock, oversold or overbought? These are the scenarios when you want to use either strategy. I'll leave it here. Maybe next time in your next call, we can go in depth and then talk about all these little things. I want to get to a next point here. Okay, how do you manage the credit spread? Okay, for debit spread, really, there's not much you can do. You can try and roll them if you want to. Let's say I am here. Let's say I bought this position. This is the debit spread, and then I'm losing money. What happens here? You have two options. You can roll it either by strike to pay more, that kind of stuff. You can do a lot of things, but really, debit spread, right? Just to me, that's what I'm saying. I mean, always have a rule. So one day you're out, you're done with it. It becomes interesting when you're selling premium. Okay, let's say that you sold this credit spread here. Let's say I sold this credit spread. This is $20 wide, right? 10, 20 to 20 to 10, 40. I sold this spread over here. And somehow the price now is around 10.45. What do you do in this case? The best thing you can do to defend against the credit spread is to reduce losses. How do you do it? You go ahead and sell on the opposite side. You sell an equivalent credit spread on the put side. It is, you don't have to put any more cash down. You can go ahead and then sell this. What is that? 10. This is 20. 60 to 20. What is that? 10. That's what is that? 20 wide, right? I can do this. This. Okay. Notice that, I mean, if I'm in this position over here, and and then the stock price has moved all the way here, all the way down here. Now I'm losing money. The best I can do is to basically add a credit spread on the put side, and there's no more money. There's no additional capital requirement required for that. The premium collected here will lower your losses. That is the best way to defend against a credit spread. There are more complex ways you can do, but it gets really complicated. I don't get into those. For me, this is the best way I do what I do. If I'm being challenged here on the call side, I go ahead and sell on the put side to lower my losses and then be done with it. Okay, that's what I'm saying here. But guess what? This here, by definition, is an iron condor. An iron condor is nothing but having the credit spread on the call side and the credit spread on the put side. That's it. That's an iron condor. Two credit spreads. One on call, one on put side. If I remove this thing over here,
do you do it only reactively or?
Yeah, only reactively.
Okay.
Only because that's why it's called a defense, managing.
Okay.
Okay. If my trade goes according to plan, and I did something like this, right? I'm good. Make money, walk away. But if I'm being challenged, somehow I can go here and then reactively add something here just to minimize my losses, because this gives me additional credit to minimize the losses. You can add this with no additional capital requirement, none.
So you need to keep watching. Obviously, you put alerts for the current market price between
Absolutely.
your.
Absolutely. Always have trade alerts. Always have, if you use I use a trading view. I don't know if you guys know it. I use I use trading view for my charts, and sometimes let it come up. Also, you can use alerts with all kinds of tools. This is my preferred tool for my charting and then my analysis as well. Come on. Okay, here.
Is this a paid product, Coach?
I'm sorry?
Is it a paid product? Is it a subscription for this TradingView, or
you can get a free account?
Okay.
Yeah. you can go here and then set an alert here. And then if you have the app as well on your phone, you will get a pop-up on your phone as well when your alert is hit. Okay, it's very handy. So when I'm doing this, I don't spend time looking at my application or my platform because I'm always doing some things. I set my alerts when my phone rings. Oh, then if I have time, log in there and go manage something, go buy or sell something or manage something if I want to. Okay. I'm gonna go back here. So this, now let me tell you what, let's say I'm trying to trade Tesla. I don't know where the price will be, but I'm guessing it'll be between. How do you do? I'm trying to do an annotation here. What is that menu? Well, annotations. Oh, never mind. Oh, here it is. Annotation. Okay. Let's say I want my stock price to be between here and here. Okay. I want the price to be here, that if it stays in between these two prices, I'll make money. Well, the best trade that will give you this probability of success is by doing, I'll go here and then I'll remove this annotation for a second. If I do an iron condor, what does it do? It basically put a price in a range. I'm saying that now these legs here, this have to be equal size, right? Here is a 20 difference here, 20 as well. And I'm saying that I want the price to be between these two. Sorry, right here. If for the next 38 days, Tesla stays in between this range here, never touches any of the short strikes, I keep the whole premium. But again, you know that don't do that, because this is no credit spread. Get out when you've collected half of your premium, right? But this is how I say that. If Tesla stays in between this range here, I go with an iron condor. It's a very fascinating name for, well, I have two credit spreads, one on the call side, one on the pull side. If the price stays in between here, I'm making money. So Tesla can do all this dance here, can do all this dance, can even come here at one point, but as long as it ends up over here in between here, I'm good. I'm making money. Okay. That's why I never leg into a condor right away. I always start with one side, see where it goes, and then I leg into a condor. Now it's very hard to feel an iron condor sometimes. Sometimes you got to leg into it. You put in this side first, and then put the next side. But your app will know what it means. So this is the iron condor here. When they use it for low IVR situations, which means low volatility. Basically, don't do it in IVR on a high flying stock all the time, like a GameStop or something. Forget it. You want like a very nice, smooth up, like a stock like maybe like even like I don't know, Apple and IBM, even the Qs. Even SPY. It moves up, but not by a lot. Condos on Tesla are very dangerous because Tesla moves a lot. You just like up and down, $100 a day, down to about $80. And so, you don't want that. You want like really smooth curve in between your range over time. That's what you want. Okay. So from now on, if you know of a stock out there that moves slowly in between the range over time, let's say I go here, look at my chart. Oops. This Tesla is very bad. You can go for something like, let's say IBM, and you'll find it. For IBM, if you look at this range over here, over these few bars, IBM is basically range bound here. IBM moves like an ETF, basically. See? I can put a condor on this. Same thing here. There's a huge gap down here, but Normally, IBM moves like an ETF, very nice range or something. Okay, so now you know.
Yeah. So, Coach, time check, we normally limit it to around 90 minutes. So
We're good. Basically, I'm done right now. I want you to cover the Iron Condor here.
yeah.
Which is our first multi-leg strategy over here. I want to leave it here so that people can look at it when they review the video.
Any last minute question, guys? We can do you have more material, right? We can schedule
Next week we can
in
have
the new year.
By the way, I'm going away. I'm going to be in Europe from the
Yeah. Next 2 weeks. Next 2 weeks we are not going to plan anything.
Okay, after New Year or something. We'll
yeah,
talk.
January. When are you back from Europe?
I'm back on the 2nd of January.
2nd of January, which is Sunday, I think. So okay. So how about that 4th? Will it be okay?
That should be okay. Yeah, absolutely. Yeah, no problem.
Yeah.
Guys, really, I mean, this is very good for me. Like, today this is fun for me to do this. Let's just listen, I don't know everything. Okay, I'm not a guru. I know what I know. I share what I know. There's a lot I don't know. So feel free to challenge me, ask questions, make me also get.
Yeah. No. This was excellent today. I think everybody learned something.
Yeah,
including you.
Absolutely. I'm doing that. I will do and then study that page today, tomorrow. Tonight is my homework. Study that page and do it very well. Absolutely.
Yeah.
Thank you.
Coach, can you share the presentation?
Yeah, let me go here. Where do I stop sharing? Yes, go ahead.
Yeah, I will share it once the series is completed. I will share the presentation.
We will. I'll make you guys like a packaged set of slides.
Yeah.
Yeah.
Okay. Thanks.
Thank you. Thank you, Coach. Thank you, everybody.
Appreciate it, guys.
Thank you.
Thank you. Good night.
Thank you very much.
Cheers.
Bye.
Good session.